Hello, this is Jordan, and this is your Precious Metals video market update. This is being recorded on the afternoon of Tuesday, July 7th, 2015. And first, we're going to show a weekly chart. You can see the weekly candle chart of gold at the top, silver at the bottom, and today was really the start of what should be the final breakdown of this bear market. Silver in particular got all the way down, I think, to the low 14s or mid 14s, whereas gold got down to a low of 1146 or 1147, ended up closing at 1152, and that would be a new weekly low for gold. Obviously, we're still early in the week. Silver, you can see there's a clear breakdown there. So even if metals pop back to resistance over the next day or two, that's not a bottom or a buy signal. We're at the beginning of a breakdown here, and I mean, this could get nasty, as evidenced by today. And that's all I got to say for this slide. So let me move on to the next one. And focusing on gold here, gold, and this could be the start of a big move. We see the volatility index in the middle there, GVZ. That was up a little bit today to 15. It was kind of trading around multi-year lows over the last couple weeks. And then at the bottom, that's the width of the 40-week Bollinger Bands. That's a volatility indicator. So when the Bollinger Bands are squeezing in, that means the width is really low, and you could expect a big move to come out of that. So over the last couple weeks, the width of the 40-week bands has been the smallest, or the bands have been their tightest in the last 10 years. So that's really significant. Those two indicators are telling us to expect a big move. And let's go back to the last time we had a really big move. That was early 2013. Gold was holding above that 1500 or 1550 support for a while. Then it had a major breakdown, and from that point, volatility really exploded, and there wasn't any support until around 1200 or thereabouts. So it was a pretty big move lower, a pretty big breakdown for gold at the time, and we're setting up for something similar, although it probably won't be quite as bad. As I said in the last slide, gold closed 1152. That's below its weekly low for the bear market of 1158. Now the next big strong support is around $1,000. So keep that in mind. As we see gold go lower, it's probably not going to have any sustained rebound or bottom until somewhere around 1,000. So keep that in mind. And gold is a move below 1140, and it's probably going to break out of this wedge formation, and that's just going to accelerate the breakdown, and volatility and momentum will increase, and that will move this market close to 1,000 quickly. I don't know how quickly. It's probably not going to be a couple days or a week or two. It may take a couple months, but who knows. Next chart. This is the updated bear analog for all of gold's bear markets. And one thing I want to note is, and this is true with many markets, crashes in over 50% bear markets, you get a 60 or 70% bear market or a crash, those things happen very quickly. They usually happen around 2.5 years or even sooner. So we've seen it in so many markets. I mean, go back to 2008, look at China and oil. They both crashed, were down 70% very quickly within a year. I mean, those are just two examples, but with most major markets, when you see a severe bear market like that in terms of price, it happens within 2 or 3 years. You don't tend to see a really long 4, 5, 6 year bear market and something goes down 70%. I mean, maybe there are cases of that, but they're probably very, very far and few. So what I'm getting here is, just in my research, I really see no case for gold to go. I mean, maybe I can make a little case for 900. It retests the old high of the last bear market. But really, when I'm looking at gold as far as where is this bear market's going to end, I'm looking at maybe 950, 960, 970 to 1,000 or that range. To give it a really big range, you could say maybe 960 to 1040. I think somewhere around there is where we're going to see gold bottom. I think the calls for 800, 700, they're really emotional, and there's no technical basis for that. There's no fundamental basis for that. We're not going to see real rates continue to spike. That's just not going to happen with the way economies are struggling, the way markets are rolling over. And you can see it in this analog chart. Whereas most of these bear markets, the one that wasn't a crash there in the early 80s, again, that one was down. Looking on the same scale, that one bottomed below 700. All these other bear markets in gold bottomed somewhere from the high 1200s to about 1,000 for that one. That was, when was it? I'm sorry, I'm colorblind, but 75 to 76 one. Yeah, that was about 46%. So given all those reasons, that's why I am looking around the 950 to 1050 area for the end of this bear market. And really, again, I just don't see anything in my research for 800 or 700. The only way that would happen, in my opinion, is if gold isn't a secular bear market and gold has a big rebound, sometime in the next 6 to 12 months, and then it comes down after that. So if you think that target's going to get hit, I think that's the scenario where it could happen. I don't think that's going to happen, but just pointing out what the scenario is. Anyway, let me move on. Some other things I've been talking about to my premium subscribers. Sentiment in the market, obviously in the big picture, bad, long bear market. Sentiment's really bearish. But looking at the indicators, looking at the data, I mean, this is factual evidence. The sentiment has not gotten to an extreme yet. I mean, this chart has all my COT information in it for gold. Again, I look at things as a percentage of open interest. And in bold, there's the net position, and then the gross shorts, gross longs at the bottom. And we can see the net position was just below 17% as of last Tuesday. Clearly, after today, the next reading, maybe it'll be 10% or 8% or whatever of open interest. But we can see that if you go back to 2013, and we kind of had the false double bottom in gold, the net position bottomed at around 5% and 6% of open interest both times. So gold, as of the last reading, the net position was not even close to that yet. It was 16.9%. That's way above 5 and 6%. Now, obviously, in the next couple weeks, it'll probably get close to 5 or 6%. And the other thing is, if we see the net position go to 3 or 4%, then that would be the smallest net position in 13 years. And that is extreme bearish sentiment. We don't have that right now, but obviously with the market breaking down, we're probably going to get that fairly soon. So keep that in mind. Another sentiment indicator that I track for premium subscribers, I plot the info there at the bottom, or the data I should say. It's the put-call ratio, all the put calls traded on all the exchanges for GLD. And I smooth it with a 20-day moving average, and that has lined up reasonably well with important lows in gold, which I've plotted there above. And I don't have the data yet for today, but the 20-day moving average is at 0.79 as of yesterday. And looking at the peaks in the put-call ratio at the end of 2013 and towards the end of 2014, the peaks were around 1 to 1.25 in that moving average. Again, as of yesterday, it's 0.79. Maybe after today, it's in the low 0.8s, 0.80s or whatever. But like the COT, it's not showing extreme pessimism yet. It's not there yet. So we got to keep that in mind. So obviously, I'm saying all these negative things for precious metals in the near term. Look, sentiment is not negative enough yet, but it will get there. The market's breaking down, but it's still a ways from that really strong support around 1,000 to 1040. But one thing that's going to be good for gold eventually is we see the stock market is starting to crack. Now, this is a chart here of the New York Stock Exchange. At the top, I have the percentage of stocks on the NYSE trading above their 200-day moving average. Now, below that, that's the number of new 52-week lows. Below that, that's the advanced decline line. And in the chart itself, I use a 400-day moving average, and you can see the blue arrows. I mean, look at how perfectly the 400-day moving average defines the trend. And sticking with that, the NYSE has tested that twice in the last 8 or 9 months. And even today, it went below the 400-day moving average, but stocks recovered. But still, I mean, this looks like a precarious situation for U.S. equities. I mean, a lot of other markets are starting to break a little bit, and if that continues, the U.S. market is probably going to follow. So the price action there, I mean, it's looks like it's kind of topping a little bit. It did bounce today off that moving average, but this doesn't really look like a strong market right now. It looks like a toppy market. And just go back up to the top, and you can see the percentage of stocks above the 200-day moving average. I mean, late last year that fell to around 25 to 30%. I mean, if that figure gets that low again, it's going to be hard to argue that we're not in a new bear market. You can see it's sporting a negative divergence. It peaked around 80% in early 2014, and the recent high was in the very low 60% area. And I've put I've made that yellow there, just like I made yellow when the market kind of peaked in early 2007. And look, every market peak is different. We're not going to set up and make this long, perfect top like we did in 2007. At least I'm guessing it's going to be different than that. But we can look at these indicators, and look, you can see more stocks are starting to make new 52-week lows. That's increasing. The stocks trading above the 200-day moving average, I mean, that's breaking down and falling apart. And the advanced decline line is still relatively strong, but it was still relatively strong there in the middle towards the end of 2007. It was only a little bit off its highs when the market peaked. So, again, this is going to be a good thing for precious metals. Precious metals and gold needs the stock market to crack before they begin their next bull market. So I don't think it's going to happen in the next month or two, but maybe not so far after that. And at the same time, we're not talking about the dollar in this video, but I do think the dollar is going to go above 100. It has another big leg higher. And so the combination of the dollar getting too strong and the stock market correcting 10 or 15%, those are the things that are going to make global monetary policy a lot easier. And then that is what's going to be, in my opinion, potentially favorable for precious metals and what will kickstart the next bull market. But just something to keep in mind. I don't see it happening, in the next week or the next month. It's probably going to take a couple months for precious metals to bottom out. Okay, thanks so much for listening and watching, everyone. I appreciate it. You can follow more of my work at thedailygold.com. And again, thanks for your time. Wish you all the best in your trading and investing, and we'll see you again for another update in the next week.